Compared to last year, it was the total top line is slightly lower in this quarter. But in our business, actually, we don't comparatively look at quarter to quarter because we give a complete outlook of the year. The outlook of the year this year also, we should be growing around 15 to 20%. And this quarter, approximately, the margins are better. The EBITDA margins are 9% on a console level, higher than 9%. And the PAT margin regions are quite similar to what we achieved last year. Last year, similar time, a lot of the shipments were going and export orders were going on. That's why that particular quarter was done quite well. But looking at the overall outlook of the year, the next two quarters are also very positive for the company. And we are within the reach of the guidance which we have given.
Well, that's fair enough. You mentioned about margins. There was an improvement that has taken place. Overall, if you look at your FY25 guidance is also, that is about 10%. And you expect this to go further to 13% by FY26. So talk to us about what are the kind of operational levers which are in place that is leading to this kind of margin expansion that you're looking at for the next 2 to 3 years.
So basically, yes, this year the guidance, we would be reaching between 10 to 11% of EBITDA by the end of the year. Going forward, 26, 27, we are looking for a more healthy turnover with our subsidiaries such as Saudi and SS coming into foray and starting. So definitely the same staff, everyone is same at the HO. Our cost is divided once the turnover goes up, and that would obviously in turn increase our EBITDA margins. So 26, 27, we are definitely looking at a much healthier EBITDA margin between 11 to 13%, and we are confident that we'll be achieving that.
So while 15 to 20% is the growth outlook that you're giving for FY25, what is the kind of revenue growth, the incremental revenues that you expect with the new capacities coming in picture from FY26 onwards?
So FY26, in the revenue growth itself, we are looking at around 30% jump, 30 to 40% jump in 2026. And, when those new units are stabilized, we are looking at approximately $1 billion of total top line revenue by 27 and 28, once both the new units are stabilized.
All right, so 30% is the number that one should be looking out from FY26 onwards. Now coming to your order book, the order book stood at about 3,100 crore. This also included a very big ticket size order of about 1,800 in this first half. Can you explain, going forward in H2 or even FY26, is the plan to capture more of these big ticket size orders, and would that be the domestic or more in the international market? If you can give an outlook on that.
So I think the big ticket size projects are there in India as well as abroad. But I think the oil and gas industry is booming, and that's how we are doing larger export orders. Currently, we are already bidding for quite a lot of large export orders, and that's going to be pretty much the trend going forward as well. Even this year, we will be 80% exports and 20% domestic. And so definitely larger orders of the scale that we've already got, we are already bidding for those. And hopefully we should be getting something for the next year and the year coming forward.
Okay, so 80% from domestic and 20% from international, that is what we are looking at for.
International, sorry, and 20% domestic.
Okay, 20.
Yeah.
Okay, so considering that, I want to understand what is the kind of order pipeline opportunity that we are looking at, and what usually for Man Industries is the success ratio that you convert from these pipeline opportunities that we are looking at for the projects that you're bidding.
Correct. So currently the bid book would be around 13,000 odd crores. And it's quite a robust bid books because you keep putting in the bids with the new orders which are coming in. And around 20 to 30% is our success ratio. It also depends a lot of times on how aggressive we go on certain orders, because we also have our qualifications, which we want to be there. Certain places we want to take orders because we want to be present in those countries. So definitely the bid book is increasing. We are getting more and more qualified. Recently, we got qualified for Shell as well. So more and more places that we're getting qualified and bidding, our bid book is increasing. And accordingly, obviously, the turnover and everything of the company would also be increasing.
All right, that's fair to understand. Now, moving on to the next question, I want to understand what is the progress that we're looking at with some of the capacity expansions. You talked about Saudi Arabia, there's one in Jammu. Can you expand on what's the progress there and what are the capex plans that we have for FY25? Are we looking at a change in the capex number for this year? And also, if you can give us a perspective on the next year's capex number.
Yeah. So both the projects are going on quite swiftly. We should be under operation in Saudi Arabia by August 2026, and by August 2026 also the Jammu unit should be in operation. Capex plan are no further expansion plan as yet because we want to complete this capex, stabilize this, and then we would be further, planning our capex and the strategy of investments. So currently, both the projects, which would, be able to give a top line of almost $500 million, are on progress and should be achieved by probably third quarter next year, like I discussed.